As an investor, what are your predictions for 2023? As an investor, actually, I actually don't mind higher mortgage rates because that thins out the herd. There's going to be less investors out there that are competing for the same deals that I'm looking at. I'm from the philosophy, look, if there's meat on the bone as it stands today, knowing that the ultimate goal, when rates do drop in the next year or two or whatever that's going to be, to do a refinance, obviously, and 100% of that refi is going to convert to my net bottom line cash flow position. That being said, there's a lot of investors that are just sitting on the sidelines thinking, well, I'm going to wait for interest rates to drop a point or two over the next couple of years, but at the same time, property appreciation might be going up 5% on that same property. How do you balance that, and what are your predictions as an investor?
Well, as an investor, I don't try to time the economy. From real estate, I look for a 7% cash on cash return. That means if I can see the return that I like, I'm not going to sit here and change my decision based off of what's happening with interest rates, what's happening with the economy, because I want to make sure I have enough buffer based off of what's happening. Now, of course, I'm going to be paying attention to it. Higher interest rates cause asset prices to go down. They push asset prices lower. So in 2023, when you ask my prediction, it's going to ultimately go down to what the Federal Reserve Bank does. But I anticipate, again, this is my opinion, I could be wrong. I anticipate pain in the economy. I anticipate pain in asset classes. And I don't think it's going to be just a 2023 thing. I think it's going to continue on. And sometimes you see a deviation between assets and the economy. Now, you can see the stock market go up when the economy is going down, and you can see the economy go up and the stock market go down. So you can see a deviation between assets and the economy. I think that there's going to be economic pain ahead. To what extent? Well, that's going to depend on what the Federal Reserve Bank does. And unlike previous times, we don't have the same capacity to stimulate and do quantitative easing like before, because before the 2008 crash, before the 2020 pandemic, before the 2001 dot-com burst, we weren't worried about inflation. And so when the Fed did quantitative easing after each one of these economic slowdowns, well, it was okay because we didn't have an inflation issue. Well, now, if we see an economic slowdown, the Fed also has to contend with an inflation crisis. And so that could potentially, again, I don't want to speak for what the Fed will do because sometimes they do things that no one expects, but it could make them stimulating and cutting interest rates a lot more difficult.